Stop everything right now. What you're seeing on your screens isn't just a rally, it's a financial paradox so rare, it breaks every traditional model. Usually, stocks and gold move in opposite directions. One goes up when confidence is high, the other when fear takes over. If you're watching the tickers and the headlines, you might think this is cause for celebration. The talking heads are calling it a Goldilocks economy. Politicians are taking victory laps. But I need you to understand something critical. This simultaneous surge is not a sign of strength. It is the hallmark of a dying currency. It is the terrifying signature of what economists call a crack-up boom, the final chaotic phase where the public loses faith in the money itself and panic buys anything tangible. Think of it this way. When the stock market in Venezuela went up 1,000,000%, were the people getting rich? No, they were starving because a loaf of bread also cost 1,000,000% more. The number went up, but the value collapsed. We are now witnessing the same phenomenon in real time in New York and London. The S&P at 7,000 doesn't mean Apple sold more iPhones. It means it now takes 7,000 devalued dollars to buy the same basket of stocks that cost 5,000 just months ago. That's not growth. That's an inflation adjustment. And gold. Gold at $5,300 is the lie detector. If the economy was truly booming, if confidence was real, gold would be falling. You don't rush to buy fire insurance when your house is already fireproof. You buy it when you smell smoke. Gold at this level is the market screaming that the entire financial house is on fire. This is the inflation tsunami arriving on shore. The first wave is the price surge. But the second wave, the wave that crushes economies, is the shortage. And that wave has already hit. While the screens flash green, a silent catastrophe is unfolding in the real world. The price of $115 silver is becoming a theoretical number because the metal itself is vanishing. We need to talk about the Shanghai Blackout. Reports are coming in from Shenzhen, the electronics and manufacturing heart of China. Major manufacturers in the Hubei district, the world's jewelry and precious metals hub, have gone 15 days without receiving a single bar of silver from the Shanghai Gold Exchange. 15 days. The orders are placed, the money is wired. The response from the vaults: silence. The trucks are empty. This isn't a pricing problem. It's an availability crisis. Silver is not a speculative toy. It is an industrial necessity. You cannot build a single solar panel, electric vehicle, or smartphone without it. When the factory lines in China stop, the ripple effect will freeze global supply chains. This vacuum in Asia is creating a global drain. Where is the metal going? It's being pulled from the West to fill an insatiable Eastern demand, but it's still not enough. This has led us to the most bizarre and dangerous symptom of this crisis: the liquidity trap. Here is what no one is telling you. You might look at $115 silver on your screen and calculate your paper wealth. But if you pick up the phone to sell your physical bars today, you will likely get a shock. Dealers are not offering $115. We have confirmed reports from industry insiders that major wholesalers are either refusing to bid on large bars or offering prices 20 to 30% below spot as low as $90. Why? Because the dealers are cash poor. They spent the last month emptying their bank accounts to buy inventory for the panic-buying public. Now, with prices vertical, they don't have the liquidity to write you a $50,000 check for your stack. They are long metal and short cash. They can't hedge because exchange margins are through the roof. So they lowball you, hoping you're desperate so they can flip your metal to a true industrial buyer and stay in business. This creates a bifurcated market, a screen price for paper and a street price for physical, with a massive, paralyzing gap between them. This is what happens when a currency system seizes up. So here's the verdict in this bipolar reality. On one side, paper euphoria, green screens, all-time highs, and political victory tweets. On the other side, physical collapse. empty vaults, frozen supply chains, and a broken dealer network. This is the moment where most people make the fatal mistake. They see the high price, get the lowball offer from a broke dealer, and panic sell their generational wealth for devalued cash. Do not be that person. The dealer's liquidity problem is not your problem. You are holding a globally scarce, industrially essential asset. The temporary cash crunch in the middleman market does not change the fundamental value of what you own. Wait, the industrial end users, the Teslas, the defense contractors, the Chinese state manufacturers will not offer you $90. When their production lines stall, they will pay $150, $200, whatever it takes. They will bypass the broken dealers entirely. And remember the ultimate contrarian signal we just got. As silver broke $115, one of the most famous voices on Wall Street went on record. I won't say his name, but his initials are Jim Cramer. He tweeted that the move was ridiculous and parabolic, telling everyone to sell, sell, sell. This is the man who told people to buy Bear Stearns days before its collapse. His public capitulation is not a warning. It is a bullish, all-clear signal. It tells us the smart money narrative is still bearish, meaning the public mania phase hasn't even begun. The real FOMO is still ahead. The math is simple and brutal. Paper is infinite. Silver is finite. The S&P at 7,000 is the scoreboard of inflation. Gold at $5,300 is the alarm bell. But the empty vault in Shanghai and the paralyzed dealer in New York, that is the truth. The inflation tsunami is here. It is first repricing everything, and now it is breaking the physical plumbing of the market. Hold what is real. Do not trade your finite, tangible assets for a currency in its final stages of devaluation. This isn't just about profit anymore. It's about preservation. Hold the line.